A lot of us here today are starting professionals in our career. Some of us are in our mid-careers, while some of us are seasoned veterans. I guess there's a common theme that links us all together, the need to invest the surplus that we generate. For some of us, we're looking at investments as a career option. And for today's session, the person who's going to be taking this event who's going to be talking us through his journey is probably one of the most ideally suited persons to talk us about how investments can actually be turned into a full-time profession. Um, Sometimes there's a misconception in our minds that to start out in a profession like this, you need to have a huge initial corpus, probably which can be deployed to generate some kind of a sustainable return over the short term. So there are myths, probably not myths also, probably there's some truth to the fact. And there's no better person than today's speaker for our event, Mr. Basant Maheshwari, who had a very similar discourse in his life when he ventured into the field of investments. From being a business owner to seeing the lows of business because of certain government intervention, to discovering his passion for stocks, to burning his hands in the initial investment uh, ventures that he undertook to take, that he took, to then getting back into the basics of investments. And how do you think he prepared himself for the profession? One, the question of sustainability, and the other to prepare in order to make better investment decisions in future. A lot of us here today probably are already into the field of making investments, are already studying towards being investment professionals. How many books, ask yourselves, how many books have you read on the subject? How many investors are you following on the subject? And then try to compare that to the man, compare it with that of the man that is here today, in order to discover what differentiates the success that he's had with what we are aspiring to have. Without much ado, I'd like to invite Mr. Basant Maheshwari to please come up on stage, and I'd like you all to please welcome him with a big round of applause. Thank you, sir. Now, today's event is actually divided into two parts. The first part is centered around Sanjeev will share his views on various ideas discussed in those concepts. Can we please welcome Mr. Vinay Bagri to come up on stage? Thank you. The next part of the event would be based on Mr. Basant Maheshwari's reading in the equity markets in terms of the strategies that need to be followed, whether in his views the markets are overbought, oversold, or whether elections play an important role in the markets or not, how we need to step up our investment decisions, what kind of factors do we need to keep in mind in the short term or in the medium term or in the long term. So without me occupying any much of your time, I'd like to pass on the microphone to Mr. Vinay Bagri and Mr. Basant Maheshwari. Thank you so much.
Thank you everybody for joining us this Saturday afternoon. Welcome you all on behalf of IAIP to this wonderful event. Once again, I'd like to welcome Basant ji. He has been a friend, philosopher, mentor, guide for IAIP. He has been associated with us in various initiatives, especially the CFA Institute Research Challenge, and where he has really, I think he really likes to give away. He is a great example of joy of giving. He likes to share his wealth of information and also tips how to get wealthy. So, and today I'm sure all of us will benefit from some of his expertise. So this is the first book reading event we are ever having for IAIP, and I'm glad we are starting with Basantji once again on this. So before we start, I think I was the first few probably to get this book, okay, and I must confess that I have read not maybe 1/4 of the book as yet. I'll tell you why also. How many of you guys are familiar with the concept of Michelin star restaurants? Michelin. So when you go to Michelin star restaurant, you just go, don't go and gobble up the food over there, right? You go and savor each and every chunk of piece, morsel of food which you eat. So this book is like that. You will enjoy each and every paragraph of it, let it sink into you, and appreciate it fully before you just finish it off. So I think that's a parallel to the restaurant, and I think each para of a book is like a gift to the reader. It's just so much information. Just think over it. It's an easy read, no doubt. It's a very easy read, unlike very complex books which are there on the finance. But the idea, I think, the intent of the book is to empower every reader to how he can have financial freedom to stock market investing. So once again, thank you, sir. Thank you so much for writing this wonderful book for all of us. So the way we'll do the format is, I have highlighted a couple of sections of this book, and I'll ask a couple of questions. If you have some questions on the text which I'm reading out, please feel free to ask him, and probably possibly
Sure.
answer that. Okay. Before I start, that's the first quote of this book. किसको ज़्यादा कमाना है, किसको जल्दी कमाना है? ज़्यादा किसको चाहिए? Lift your hands. ज़्यादा and जल्दी? दोनों ज़्यादा and जल्दी? No. दोनों. So I think this is a very apt quote, which is there on the first author's note. Most investors can't figure out कि पैसा जल्दी बनाना है या ज़्यादा. I think this is a very simple. It's a seemingly very simple quote, but I think all of us are always in a state of mind. Okay, we have to make quick money. Stock market is a way to get rich very quick. Okay, sorry. So maybe Basant, if you can share some thoughts on this striking sentence, please.
The question is, some quotes look very good when you read them, and you for a moment you just sit back and you say, oh wow, क्या लिखा है? But after a while, if your friend calls you up and tells you what are you looking at, and you tell him the old idea which you had bought 3 years back, he said कुछ नया बताओ. And at that moment you also feel that maybe there is something for you to do more. Like now there's an election around the corner, and most people would be looking at certain stocks which they need to buy only for the election. So then you realize that there's a big question of how money can be made. If you've read through the book, in chapter 2 you will see that I have elaborated on 3 points. Was the initial capital, the CAGR, and the N, the number of years. So most of us, jaldi is the rate of return. आपने 1 रुपया 10 सेकंड में बना लिया is जल्दी, या आपने 1 लाख रुपया 1 महीने में बना लिया is ज़्यादा. But the point is the rate of change is immaterial. What matters is where you go finally. So jaldi and ज़्यादा is more of, you open up your television box, and very appropriately we call it the idiot box sometimes. So they'll always tell you buy this today, it's going to go up 10% tomorrow, and then you sell it out. So wealth is not made by buying stocks that move up 10% or 15% or 20%, because you were not poorer by 10, 15, 20% for you to have said, okay, this is done, now I'm free with my life. If 10, 15, 20% was the only thing that was holding you back from reaching financial independence, then stock market is not the way to be there. Go and put your money in a bank FD. Wealth will be made only if you grow it 10, 15, 20, 30, 40, 50 times. For that, you have to leave the jaldi part and focus on the ज़्यादा. Because when you focus on the ज़्यादा, you don't tend to lose money. But when you focus on the jaldi, the chances of going back to square one is also very high.
Moving ahead, and I think this book is replete with such kind of witty quotes and such in-depth statements full of that. Now moving ahead, in chapter 1, I think this is a strong behavioral aspect, I think, which plagues every investor, including myself. Though I have been in the stock market for quite some time, but I have not been able to overcome this problem. Okay, here you have mentioned an investor has to be lazy in taking profits and agile in cutting losses. Thereafter you have, in the following paragraph you have mentioned, buying more of a stock after it has moved up from an investor's initial purchase price is a lot tougher than selling it to lock the gains. So basically what I'm trying to say is that once the stock, people are in a hurry to book profits, and this is a common problem, I guess.
Yeah, that's the point is, if you read that statement, investor has to be lazy in taking profits and agile in cutting losses, you'll say, oh, this is what traders do. Why should an investor do like that? It's for a trader who says let the profits run and you have to cut the losses. But if you are an investor and if you want your stock or your investment corpus to grow 10, 15, 20, 30, 40, 50 times over a period of time, and if you have a habit of selling only if the stock goes up 20%, then how can you see a stock go up 40 times? Another question which one has to think about is, if a stock goes up 20% and you have to sell it every time, then you would need a new stock, because if you keep selling a stock and it goes up 20%, then you've got to substitute that with a new one. So the point is that you have to be agile in taking cutting losses and very lazy in taking profits, because a stock that you bought, let's say a stock which I have personally bought and I've recommended this several ways, and also in the book I've elaborated on it. It's called Page Industries. They manufacture the Jockey brand of underwears and things like that. My first purchase was 350 and the last purchase is at 5,600. So you can say, why did you buy it 5,600? You could have bought everything at 350. The point is, I cannot buy today's stock at yesterday's price. If the stock has gone up and I get the money today, then I have to go and buy it today. I cannot buy it at the price it was trading at 4 years back. And many times, it is better to buy a stock that has gone up on improved earnings rather than to buy them after they drop in a string of bad earnings. So the easiest thing in the market is the most toughest to do. So if the company is doing well and the price has gone up, you don't go out and buy. But if the company is doing well and the price has gone up and it is supposed to do well, the earnings are supposed to be doing equally good, then you keep buying with every increase in price, because the money that comes to you will obviously come at intervals, as most of us are salaried or have fixed income profiles. But the point is, when a stock does well, the price goes up, the earnings also increase, then the investor also feels confident about that company. It's very difficult to feel confident about a company in the very first initial stages of growth. So when the company has demonstrated its ability to grow for 2 years, 3 years, 4 years, then you're sure that what the management is saying, they will do it. The management also gets tested by its past predictions. You can also qualify yourself by saying, okay, the management told us that they're going to do this and they've done that. So I think it's better to buy a stock once it goes up rather than to buy it everything in one go and then sit on a pot of problems the moment anything goes haywire.
Just to follow up, I think when you started your investing career, did you face such kind of challenges? Okay, I have made some, because I think in your book you have mentioned that how you started from nothing, right? Everything, some problems in Kashmir, etc. Were you tempted to take profits, book profits, take everything on the table early? How did you overcome such
I'll
kind
tell
of?
you, it was my initial visionary thought, a borrowed one of course, was that whatever happens globally happens in India. जो कुछ बाहर होएगा इंडिया में होएगा after a lag of 10, 15, 20 years. So if you had organized retailing doing well in US in the 70s and 80s, it will do well in India after 20 years. If you had Fannie Mae, Freddie Mac doing well in US in the 80s and 90s, you had HDFC doing well. If you had a Wells Fargo doing well there, you will have a HDFC Bank doing well here. So that combination of applying global business models into Indian context and then thinking whether they can work or not was the initial driving force that got me into thinking that you can do real big things with the stock market. And luckily, I wouldn't say unluckily because we made money out of that, I bought Pantaloon Retail. Possibly had I known so much about investing, I could have skipped Pantaloon at that time because it was a negative cash flow company, diluting equity, raising debt, holding an inventory which wasn't valued in terms of how it should be valued and things like that. But when I bought Pantaloon Retail, the idea was Walmart has done so well there, so maybe Pantaloon can do well here. Of course, now that the question was, can they survive 10 years? But who needs 10 years if you can make 40x in 5 years? So the stock market is very different from running a business. Because when you run a business, you have to go out and show profits and then pay taxes and then you can distribute them as dividends. But if it is a stock market, everything gets discounted today. So if Narendra Modi is voted to power, as the entire investing community thinks they should be, so the companies might take 2 years to report earnings, but everything will happen today. So to that extent, my initial thoughts were that if I bought Pantaloon Retail, I should not sell it very cheap. So, but when the stock doubled and then doubled again, so obviously there was a lot of stress to sell it. But then the only thing was I kept looking at Walmart, kept seeing their price history. Of course, that was a wrong comparison because Walmart had a very different model. They started from one region in US and they started expanding very slowly. But Pantaloon was all over the place. One store in Chennai, the other one in Kanpur, and the third one in Bombay, and the fourth one somewhere else. So, but stroke of luck, tailwinds, and a sector which is in demand. A sector which is in demand always does well. Whether the company does well or not, the investors will do well for a period till the time the sector is in demand.
And please feel free to jump with any questions you have. Please.
So one question, since you said that whatever will happen globally will happen in India after 10, a lag of 10, 20 years. So suppose the organized retail did well in 20 to 30 years before. So how come means at a point you came to decide that this is the time that organized retail will do well?
No, that is not very difficult because those companies were growing revenues at 100%, 80%, and there was a McKinsey report which said that India will become so big and organized retail, which is at 2% of the total retail market, will grow to 20% and things like that. So there were confluence of events, but more or less it's an educated guess. Whether you're an investor or a trader, investing in stocks is a bet. It's not a fixed investment. So that was a bet that one had to take. And of course, the companies have to do well also. You just cannot buy a stock and say, no, this will happen after 25 years. The companies have to give you the first indication that they are on track to do what you want them to do. And that indication will come from rising sales, rising profits, expanding markets, and a general change in the culture. In 2003, there were more people willing to go to Big Bazaar and Pantaloon than there would have been people willing to go there in 1993. So if Mr. Kishore Biani had opened up his stores in 1993, he would have had to close them all. The market wasn't ready for it. So there are some things where the market gets ready. It's like being at the right place at the right time and all those cliches combined together. But basically it's there's no single formula answer here. I mean, you've got to take those bets and you have to see, and it's better to be late in a very strong trend rather than to be early and expect the trend to develop. So even if you're late in 1 year, late by 2 years, it doesn't matter. But if you bought the stock in 2000 and say in 2005 this will happen, no, that's not how money is made actually.
Thank you. And just quick question to everybody. So how many of you guys are like independent investors over here? Not salaried, not doing a fixed income. You're working, making money in the stock market, right? Or investing. See, stock market typically offers lumpy returns, probably, right? You don't have a fixed stream of revenues. You don't get a dividend maybe coming in certain months like September, October is the dividend season. Otherwise, you may have capital gains. So stock market is not a easy place to make money. It is a long haul, and you have to be patient. Probably that's one of the virtues, attributes of it. So in this book on page 8, you have mentioned about to attain financial freedom, an investor must strive to have at least a corpus of 50 times his annual expense.
I'll start on that. See, say my annual expense is 5 lakh rupees a year. Or say it's 10 lakh rupees a year. Because apart from roti, kapda, makan and cable TV, I also want to go to Diga for a holiday, small one. Okay? So if it's 10 lakhs, and that means in 50, it means you should have a portfolio of at least 5 crores. So the logic is, if your portfolio is worth 5 crores, then on an average, you should be able to get a dividend yield of 1.5 to 2% on any set of portfolio, provided the portfolio is not made up of junk stocks. Some stocks will give you higher yield, some stocks will give you a lower yield. So on a 5 crore portfolio, if you get a 2% yield, it works to 10 lakhs, tax free in your hands, as on date. So that's enough to take care of yourself. Another way of looking at it is, if your portfolio grows at maybe 10% or 12% every year, and there's an inflation aspect of 6% to 8%, on an average inflation grows by 6% as per the government data, but for urban Indians who are aspirational, there's an inflation of 10% because your children's school fees don't increase by 8 or 10%. From 2,500 they go to 3,000 straight, so it's a 20% inflation, right? So taking that into account, if you have an inflation of 10% and if you expect your investment to grow at 10 to 12%, at least, if you don't expect it to grow by 12%, please don't come into the stock market. You should be putting that into the bank FD. So you have a corpus that is well protected by the loss of purchasing power every year, and you get almost a 2% yield. So the idea of giving that figure was, most of us, including myself to a very large extent, are unaware of how much is enough. So you got a very nice job, you got a very good factory, you got a very good company, you're working well, you don't know how much is enough. You always say, okay, if I reach this figure, then I'm going to say I've got enough. If you start, the first target to reach is, I think, 25 lakhs in life in terms of wealth. the next target becomes 50, the third target is 1 crore. And from 1 crore, the next target is not 1 crore 25 lakh, it goes straight to 2.5 crores. Then you say, okay, I want to be a millionaire, dollar millionaire. So the next target is 6 crores. And by the time you reach 6, the dollar goes to 80. So that's another problem there to handle. So then it keeps on growing up. But at least you should have a point where you can say, okay, this much is enough for my financial security, and then we can take care of other things. Now you can say, what if the portfolio falls? Okay, that's okay. That's why we are focusing on dividend yield. A portfolio should have a yield of 1.5 to 2%, and that should be enough to take care of your day-to-day needs.
I think one unique thing which I found about this book is that in addition to the mind, this book has written from the heart. It is a tell-all kind of book. Because Basantji has really covered several personal aspects of his journey, how he started, his school life, his college life, and it's a very, what you call, open book. It discloses all his issues, family issues, challenges, etc. And very, very clearly mentioned, the path to financial freedom is not an investor's personal journey. I was talking to him a couple of days back, where he mentioned that although I'm sure he could purchase a very high-end car, but he did not have a car. He mentioned in this book also. He did not have a car till the year 2010, and that to a second-hand one. Because his concept was that why buy a depreciating asset when you can put the same money into an appreciating asset, that is stock market. But how do you balance? Because thing is that we all family, I'm sure all of us have families, and probably you had a very nice accommodative family over here, but we have other challenges. But what role did the family play in your whole journey, and what do you expect, and how do you balance
See, this is not your individual journey. If you got money and people at your home are seeing that your stocks are going up and they want a nice holiday, France holiday or whatever, it is very difficult for all members of a family to think alike. So one of the members will have to think in certain direction and then try and convince the other one, sometimes by debate, sometimes by discussion, and in most times by argument. So once you do that, but ultimately it's everybody's support. You cannot do it yourself. Because at one point you have children, you have parents, you have your spouse, and you cannot make them feel that you are torturing them for money. Like if you have it and you not spending it, and today in the world of Facebook, where either when a person announces to the world before his aircraft takes off that he is going on a foreign holiday, there's too much of peer pressure everywhere. So you have to take those things into account, and overall it's a combined event. It's not a single event, but somebody has to take that hard step forward and convince the others. Either through discussion, debate or argument, that the first 4, 5, 7, 8 years of struggle could mean, I'm not saying should and will, could mean years of uninterrupted freedom from stress. Now the point is, you are not sure. There are many times where you will struggle and you will torture yourself for all those luxuries, and then you find that you haven't made wealth also. That's bad luck. But somebody has to think of it on those lines. You cannot, there are no guarantees here, but you have to take that bet actually.
You very rightly mentioned the fight remains between a bird in the bush and bird in the hand and seven in the bush.
Right.
Any questions, please? Moving ahead, you have, I think, you're a strong proponent of magic of compounding. I think that has really worked, but most of us tend to forget about it once again in the lure of quick returns. Maybe you can share your personal thoughts over here and personal success stories also. Personally, more than 90% of my wealth has been generated from less than 10 stock ideas only. Making meaningless and insignificant token investments that do not have the power to change the balance sheet of a person is only an ego massage and does nothing to advance this process of wealth creation. See, what happens is many times when we talk to some investors, we always ask for some new stock idea, and maybe I also did this crime with talking to you, probably kuch naya bataiye, and probably many other people also do that. But I don't think going by this really helps. Maybe you want to throw some light on this. How are you so convinced that just 10 stocks?
No, it's not a question of being convinced. It's a question of today you can recommend 20 stocks, 30 stocks, but the point which I have also elaborated over here, if you take a 1% exposure into a company, say somebody came and whispered into my ear 4 o'clock in the morning that, boy, I've got one stock for you. I said, oh, which one? He said, Unitech le lena. I said, okay, great. Kitna hoega? Well, it's going to go up 100 times, 2004, 2003, 2005, wherever it, from where Unitech went up 100 times. I said, okay, I'll put 1% of my portfolio in Unitech. I call my broker. Because when you put 1% of your portfolio, you will do only 1% of the adequate amount of research that you should do. If you put 30% of your corpus into a stock, you will allocate 30% of your time doing that research. So 1% of allocation means only 1% of research. So you won't even wait. At 9:14, you will tell him the moment you reach office, give me a call, and at 9:16, you would have the order punched in. So 1% allocation, it goes up 100 times, only doubles your portfolio, almost, because it's just a 100% game, 1% into 100. So that doesn't change your life, because as I said, you are not poorer by just 50%. You're not telling God, God, just double my money and I'm going to become rich. If had that been so, there are several other ways. There's no way to come into the stock market. The only way why you want to come into the stock market is that you want to say, I want to grow 30, 40, 50, 60, 70 times. So when you say that, you cannot be buying every stock that comes to your mind. Today even I get so many ideas that this is a good stock, that is a good stock. But my basic theme is, if I've got these set of 5 stocks, then are the new ones adequate enough to replace the ones which I already hold? One stock which we have gone wrong, actually, not in a wrong sense, in a large sense, is called Hawkins Cooker. The company hasn't been delivering, but at least for whatever reason, we have not lost capital on that. Recommended it at whatever price. Okay, my initial purchase was 300, 350, today it's at 2000, but it hasn't done anything for the last 2 years. But even if you go wrong, you should not lose a lot of money. But trying to buy every stock in the market, trying to play every rally in a sector in the market, will not make you wealthy. It can make you income. So the question is, if you are only wanting to make income, then stock market is not the place to generate income. It's a place to create wealth, actually.
So when did you really realize this revelation? When did you have epiphany on this? That okay, you have to really focus. Did you commit some
No,
mistakes?
I'll interrupt your question. I've got your question. The thing is, I wanted to make big money.
Okay.
Simple. I didn't have even thousands in pocket, but I was dreaming of crores. When I used to tell somebody, he said, "Pagal hai kya?" It was like that. So when you want to make big money, say let's take any stock. Let's say Pantaloon Retail. You say it's going to go up 40 times, right? And you say 40 guna padega. I want to make big money. That's the subconscious mind telling you. And then you say, okay, let me buy 10,000 rupees worth of Pantaloon Retail. You're going to go to 4 lakhs. That's not going to change anything in you. 4 lakh rupees is nothing. It's not going to do anything for you. Then you realize, how do you put more money into Pantaloon? You can do that only by reducing the other exposures. So automatically you will get into the mode of concentrated investing, because you want to put maximum amount of money there. Like the one stock which is mentioned in the later stages of the book, which we bought last year at the time of IPO, which is called Repco Home. I bought a very small quantity of Repco Home during the IPO, because at the time money wasn't free and I already had Titan. But when Repco moved from 170 to 200, I almost bet my whole house on Repco. I thought this is the stock to be in, because you could see it's a 20-year story. Whether you buy it 170 or 200 makes no difference, because today the stock is at 380 in less than a year. So I could have bought Repco, I could have bought another stock which has done well from last year called Symphony, but I didn't buy Symphony because that stock was moving. But I thought Repco is good, so why should I buy Symphony? So I missed Symphony. So people will say, "Arey yaar, aap to Symphony khud nahi liya, aap sabko bole lekin." It doesn't matter, yaar. You put additional amount into Repco and Repco is doubled, so you're there. Because ultimately what matters is how much money you've made, and not from how and not from what stocks you've made that money. Say you were playing the construction boom. One Nagarjuna construction was enough for you. Why did you want to buy IVRCL and HCC and HDIL and everything? One stock is enough for you to make money. I mean, the richest guys in the world are all people who have made their money from one stock. At Bill Gates, talk about Bill Gates sometime in life, talk about anybody. I mean, they've all made their money in one stock. They've never bothered to put 20 stocks, 30 stocks. Warren Buffett is one guy, but Buffett has different priorities in life, so that's why he divides his money. So when you think of making it big, the first question that will come to you is, how can I put more here? How can I put more here? And as long as we are not the governor of RBI who can print currency notes and push that into the stock market, you will have to look upon yourselves and say, okay, I can put more over here only by reducing some from there. And once you get into that process, you'll realize you can't bet on more than 5, 6, 7 companies. Because if you bet on 50 companies, then you can't have more than a 2% average allocation on one company. That's not enough for you to say, I've done enough in life here, I want to, hang up my heels.
But just a related question, like I think all of us, many of our CFA candidates over here and members, and we read in our textbooks about the benefits and merits of diversification, how you unexplained risk and explained risk. You're betting so much on one company, right? If something goes wrong, maybe bad luck, you attribute to bad luck or bad judgment probably also. And how do you really hedge yourself, or how do you balance that out?
No, there's no hedging if you made a mistake. Because if you made a mistake, then that's why you don't put everything in one company and you bought 5. So you bought 20% there. So look at it from another perspective. If you expect this portfolio to grow 25% every year, and this portfolio has 5 stocks of 20% each, and one of the companies goes bankrupt, BANKRUPT, finished, khatam, khela khatam, paisa ajam. In India, the best part is even if a company goes bankrupt, you can still trade it. Kingfisher today trades at 3 rupees. So even if it goes bankrupt, you don't lose 100%. You can still lose 90, 94, 95, 96, 97, 98%, but you never lose 100%. Right? So even if one of those stocks go bankrupt, then you got 4 left. And all of them were supposed to go up by 25% each. So still you recover your money at the end of year 1. The point is, you should bet on companies in a concentrated portfolio only when you're really sure of those companies with respect to their ability to generate year-on-year predictable rates of return. Now, if you can do that, then you should do it. You can't be buying 5 stocks, Tata Steel, Hindalco, Jindal Steel and Power, and 2 more, ACC, and say 1 Nagarjuna Construction or whatever. All of them are cyclicals. Even the company's boss doesn't know what price steel would sell at the London Metal Exchange next year. So, आप कैसे उसका report बना रहे हो? How are you doing a DCF? The biggest crime that is done in the analysis industry or in the research industries is when you do a DCF for a Hindalco. Can anybody tell what price aluminium will trade at tomorrow? If he can, then he should be going and punting futures at the London Metal Exchange. Why is he doing this? So those kind of companies where you cannot predict returns, you cannot have a concentrated portfolio. So if somebody comes and tells you can buy say Tata Steel or whatever, and this is going to double up, you cannot put 20% of your portfolio there. You can only put 3%. Then you have to look for the 97% to be allocated elsewhere. So the first thing before you do a concentrated investing mode is to think of companies that can almost do no wrong, because nobody is sure. Secondly, you have to buy only sector leaders. The leaders of a sector don't go bankrupt generally. Infosys still trades. Nobody knows what happens to DSQ and HFCL. L&T is still nearer to its all-time highs. Nobody knows what happened to Nagarjuna Construction, IVRCL, and all those Punj Lloyds and everybody, nobody knows. So if you are buying concentrated, 2 things to remember is only secular growth companies only, and that means losing a lot of. And secondly, focus on sector leaders. If you can do these 2 things, then you can buy 5 stocks, 6 stocks, and then dream with stocks. That's what they say.
And you have seen it yourself, I think. Thank you so much. Now we're just, I think, talking about risk management, and please, sorry.
Basant sir, you regret putting money in Pantaloon 15 years back.
Right.
Why? I mean, as long as you make money.
No.
As an investor, probably if I see a Pantaloon now, why would I not make money out of it, even if it's a bit risk?
Absolutely correct. But the point is, the regret was, it's not a regret in a sense where I say, why did I buy it? But it's a regret in the sense that I should not have bought this. Because when you know a little more, like in the stock market, knowing too much is also a problem. Because then you say, stock market is like, it's very difficult. You can't have it's not gymnastics where somebody gets 10 out of 10. It's like an English exam, writing an essay. Teacher can never give you 20 out of 20 if you write an essay, generally, unless there's something else. But so in Pantaloon, the regret was that it was a negative cash flow company. You were it was raising debt. Debt was growing almost as fast as sales. The earnings that were growing had a lot of lumpiness in them, in the sense that they used to value inventory at different levels and things like that. But the overall point of regret is that you should not have bought that, and there was a way to make money out of it. What if Pantaloon went up so many times? Blue Star was an excellent company in 2003. So if there would have been malls, shopping complexes, and office, and ITES centers, and airports, and metro stations, so centralized air conditioning, Blue Star would have done well. There was no need for you to just focus on one company. So that's called the pickaxe and the shovel theory, which works sometimes and it doesn't. So the regret was, maybe you should not have done it this way, you should have done it that way. But there's no regret from the financial side. There's a regret from the analytical side. This is not what you should have backed. But if you made it, you made it.
So trade was the better option at that time.
No, but Trent, I didn't make money.
But
Yes, I have elaborated that. I have elaborated. And Chemex Street is almost 1 kilometer from here. I used to move from Minto Park to Chemex Street, and I used to ask the guys, "Bhaiya, Pantaloon kidhar hai?" He said, "Yeah." I said, "West side kahan hai?" Bola, "Pata nahi." And Park Circle used to send a taxi. I said, "West side leke chalo." He said, "Kahan hai West side?" I said, "Pantaloon jante?" Bola, "Haan, jante hai." That was the indication that more people were going to Pantaloon. I used to stand outside and say how many people are coming with bags out of Pantaloon, how many from West side. And every time I used to say Pantaloon mein bheed laga rehta tha, and West side you could just not see too many people any time. But the thing was that at that time, you were thoroughly confused. And I said, okay, it's a challenge if Pantaloon can do well. That was my thought. If Pantaloon does well, it's a challenge. I will not name him, but one of my friends, he had done a course from somewhere. So he knew this big investor who had given him his email ID. So I said, hey, yaar, let's write him an email and check up on the stocks. So I said, what stocks? He said, "Tum ek kaam karo, you write Bharti Airtel, you write Hinduja TMT." I said, don't write Pantaloon here. He said, why? I said, no, he will say, "Ye kya aadmi yaar, Pantaloon leke baitha hai." That was the kind of thought I had at that time, ki Pantaloon to will not do well. Because when he sent an email to an established investor, we are removing the name of Pantaloon Retail from our portfolio, just so that to create a better impression that we are good analysts finally. We are not foolish. So that was a thought. So you can understand how much I believed that it's going to make money. But the crowd told you that something's going to happen. And then when it doubled and then doubled, and by 2005-06, it was clear that Pantaloon is the leader. By that time, the story was over because the stock had already gone up.
Any other question? Any other question?
But when normally stocks run, we see that there is, Symphony is running, Bajaj Electricals will run. If Blue Star is running, Voltas will run.
Right.
People do find the second run stocks.
Right.
So should we bet on the second run also, or should we avoid it?
Second run betting should be done only when the bull market is in full force. The second run will outperform the frontliners. But if you hold it a bit longer, you will lose money in the second liners. I think between 2003 to 2007, the second liner construction stocks did well in Larsen and Toubro till January 2008. But if you've held it till April 2008, then there's a problem. So there's always a big risk in buying the second line stocks, because, and ultimately they don't make more for you also, because everybody knows that it's very difficult to exit at the right time also. But there's a great fancy in the investment world, because I'll tell you what happened. In 2000, I had a portfolio that consisted of stocks like DSQ Software and Shri Adhikari Brothers, because Karishma Kapoor was advertising "Jab dekho, sab dekho." So I said, ZTV is doing well, ab sub channel bhi chalega. Just there was one ad which Karishma Kapoor was doing, and there was no ad in sub TV. You could watch the entire channel without a single ad, and they were just rerunning their old programs, the DD programs. But I thought, no, ZTV is doing well, why not sub TV? And sub TV went from, I think, 300, 100, 200 rupees to, I think, 2500 rupees. Now at that time, Infosys was trading at a PE of 200, 250. DSQ was trading at a PE of 60, 70. But the PE is a function of earnings. If your earnings are bogus, then the PE is irrelevant. If you're not making any earnings, you're just showing up earnings, then the PE is irrelevant. So Infosys, in spite of being extraordinarily expensive to DSQ Software, returned back the investors' money and still is up 100% of the last 13 years, whereas DSQ Software is down 99% or maybe 100%, is delisted probably. So now most analysts, you say, the big guys who come on to actually deliver a talk about investing, they'll say, when you bought a very expensive company called Infosys in 2000, what happened to the world, they lost money. But sir, what happened when you bought the cheaper ones? You've lost your capital. There's no hope of getting it back. Nobody talks about that. And that's a crime, because you are not comparing apples to apples when you say that buying an expensive company is difficult. Because at that time you should also say, what would investors have done had they bought the cheaper option instead of buying the expensive companies? A fact that goes undiscovered, undiscussed, and nobody talks about it. Because there's a great fancy in the world in saying that, I'm a value investor. What do you do, sir? I look at low PE stocks. Oh, these are very high PE. Now, the ones who buy high PE stocks, I'm not being casteist in this election season, are considered to be scheduled castes. They'll say, no, you buy high PE stocks, you're a momentum investor. Now, that's a problem with the word itself. You can't be a momentum investor. Momentum and investment don't go together. But that's what happens with. The point is, the PE is a function of earnings. If the PE is low, then can anybody guarantee whether the earnings are real or not? So we should look at earnings in perspective of the PE. Then you get a better picture of whether a stock is at low PE or a high PE.
Thank you. Just a small comment. It says here on second chapter. It talks of investors should realize that this game is not about winners take all, but it's about survivors making enough. You can just explain this a little bit.
It's like, okay, how many of you would be interested to buy a stock which trades at 10 rupees today and in about 1 year can go to 12 rupees 50 paisa, 12 rupees 60 paisa? No percentage. Now you know the percentage game. Now the point is, nahi hai kya hai sir, 10 rupees ka stock agle saal 12 rupees 60 paisa. Tell us a 10 rupees stock which is going to go double ho jaye 6 mahina mein. So investing is not a cricket match where if Australia scores 434 and South Africa needs only 435 to win. If South Africa can score 380 also, they have won the match. It's not a game where only one person can win. It's not a tennis where you can't have a tie. So here is a game where if you have made 26% and I have made 18%, but you made 26% only for 2 years and I have made 18% for 25 years, then I am far well off than what you are, or the other way around. Because if you look Warren Buffett, what's so special in him? Nothing except that he has been able to maintain his 19-20% CAGR for 46-47 years. Whereas on the other hand, there have been many one stock wonders or one theme wonders who made 30% CAGR for 5 years and then blew it all up. So it's not a question of running fast, it's a question of having the stamina to run fast for the entire run. And in this game, you never say that, he is the one who is the winner, because CAGR is not a function of winning. The only function of gains and losses is how much wealth you have created over a period of time. And for that, you need not be the fastest runner in this world. You can also be a small guy who takes small baby steps but doesn't go backward. If you're running at 100 meters in 10 seconds and then you cannot run the next 100 meters because you fall off the tracks in the 11th second, then the guy who was running 100 meters at 18 seconds also wins the game. So that's it.
Going forward on the risk management framework, we have also mentioned if the risks are higher, then no matter how big the rewards are, you should sit back and introspect. Maybe can you just talk about risk management? I think it's important that you make money, but also it's important to preserve it, because many people, we have heard many stories, people have made a lot of money in the market, but they could not preserve it. They just blew it all up, they could not encash it on time. So what kind of risk management strategies which you have in place? Can you share some of them?
One is that you always have to be very paranoid of making bad investments. You cannot be fearful of failure. You cannot be paranoid of failure, but you need to be very paranoid of bad investment. So if I think that I will buy a company which is a sector leader run by management, can grow at 25-30% for the next 10 years, then I should have all those points running with me every time. I cannot say, okay, management is not good, but how does it matter? Some big investor has bought it in Bombay, so let me copy him and buy him. No, that will not work. What you need to do is you have to be very sure of what you are buying. So risk management means, because in this book if you've seen that I've also given 2 charts where you make 40% every year for 4 years, and in the 5th year if you lose 50%, your returns drop to 14% CAGR, less than that. But if you make 40% for 4 years and in the 5th year you just manage to do 0%, that is just preserve what you have made, you still generate an income of 31% net. So the point is, not losing money is as important as making money. Because you make money for 4 years in a row and then you lose 50% in the 5th year, you go back to 14%, which is nothing almost. So a negative year can wipe out years of hard work. You have chosen stocks, you have woken up at 6 in the morning, you have read balance sheets, with, but one bad decision in the 7th year, in the 15th year and the 18th year of your career can take you back to square one. चलिए अब finishing line हो गया, अब आप वापस starting blocks पे आ जाइए. So that is what happens. So if you've got a sector that is in fancy or whatever, even if you have to be trapped, get trapped in the best stock of the sector. Get trapped in Infosys. Get trapped in a Larsen & Toubro. Get trapped in, an ACC. But don't get trapped in a Master. Don't get trapped in a HDIL. Don't get trapped in a Kakatia Cement or a Kalyanpur Cement or whatever. Because if you're trapped there, then it's like digging once you're into a hole. And the best thing to do when you're in a hole is to stop digging, as they say.
Interesting. So from the year 2003 onwards, you had a nice bull run, multiple stocks. So can you share how did you manage? Oh, sorry.
Sir, I wanted to ask one thing about this. So you exited also some stocks in the right time. So how did you understand that?
Relative. The only stock which I couldn't exit at the right time was Pantaloon. Because I'll tell you, I've written also here, because the company was trying to do spin-offs. They were saying, okay, we'll float Big Bazaar as a separate company, Future Capital as a separate company, Pantaloon Retail as a separate company, Fashion as separate. So I thought, because I had just tripled my money in TV18 when they had done several spin-offs. So I was waiting for them to do a spin-off. In fact, I used to write mails, frantic mails, ki when are you going to spin them off? In January 2008, I still remember, every 15 days I used to write them a mail, ki when is the spin-off process starting? So they said, no, we are looking at the market, we are looking at this, we are looking at that. But the only way you can exit some stocks at the right time is when you have a relative opportunity. Like I exited Trent when I put that into TV18, because TV18 was getting ready for a move. They were spinning it off and things like that. So that is what happened. Like last year I exited Titan because I had Repco in mind. Had there been no Repco, probably I would have held on to Titan. So Titan is around about the same price even today, but Repco is up almost 70, 80, 90% from there. So I think the only way to exit is if you have a relative opportunity, and you have to understand that tops are made in hours. A price at the top will never stay there for 5 days. If a stock stays at 500 rupees for 5 days, near about 3-4%, then that is not a top. Don't get worried. So whenever I hold a stock which I like discussing all the time because it makes new highs every time, Page Industries. So if it goes to 6600 and it stays there for 7 days, I am sure this is not a top. Because if 6600 is the top, it will be at 6600 only for 2 hours, 1 hour. It's going to drop to 6200, then drop to 5700 in 2 weeks. One company which I have boldly come out and said it doesn't deserve to stay at this price was Gestile. I have written about it at 1400 rupees, and when the book was going into print, the stock had shot up to 1850. So I called up the guys, I said, yeah, can I make one change? He said, what? I said, I want to remove this paragraph about Gestile. He said, why? I said, because it's at I had said that it needs to be sold at 1400 and now it's gone to 1900. So he said, okay. Then when I read the paragraph again, I thought that I was making a logic. And if I removed the paragraph, the logic was also evaporating. So I said, okay, let it go. So then the stock started to fall, and from 1900, it's now at 1000 almost, 1100. So the point is that these things happen. And now if you see Gestile, the stock didn't stay at 1900 for 1 week. It went to 1900 for possibly 1 or 2 days. That was enough. So if you were an investor in Gestile, when it was coming down at 1500, you would have known story over. At least for the time being. Of course, Gestile can go up because I am not convinced, because there is just one internet company, quasi-internet company in India, and that too is also a case of what is happening. If Twitter was going up, Facebook was going up, people pushed up Gestile over here, because whatever happens globally happens in India. So the foreigners, they have a mind. They say, okay, if Twitter is doing well, Facebook is doing well, let's see what's the comparable opportunity in India. So that is one part.
Sir,
yeah.
Sir, once a top is made in a certain stock, sir, how come we know next time the move can start in 3 months, 6 months, 1 year, 3 years?
No, 3 years, no, there's a lot of time. The move has to start when, if the earnings flow are happening, then the stock will move again. But if the earnings have been disturbed, and how do you define whether earnings have been disturbed or not? If the market is expecting 30-35% earnings and the company is growing at 30-35%, then it's okay. Like sometimes what happens is the management and the investor community says, okay, so what if it doesn't grow at 30%? It's still growing at 20%. No, not taken. If a stock is supposed to grow at 30% and it comes out and says we can grow only at 20%, that's not a good enough explanation for an investor. That means that the momentum has been disturbed and no company goes back to its high growth regime ever. In a stock market, I don't know whether I should say ever or not, but no company goes back. If you are growing at 50, 60, 70% and you drop to 30, 40%, then you don't grow at 50, 60 again. There are so many factors that disturb the entire sector. First is lack of entry barriers. There will be 20 different people doing the same thing. So obviously there will be more competition and things like that. So that is one aspect to see. But if the earnings are not coming and the stock price is going up, then there is a problem. What happened with Just Dial? The earnings are growing at 26, 27, 30%. And the stock was trading at what? I don't know what kind of PE. 100 times more than that. That's unsustainable.
But sir, earning can still come up. I mean, earning can still grow, but the price can still fall.
Earnings can grow, but the price won't fall. If the earnings will keep growing, the price will wait for earnings to catch up. I've given examples here. You see, HDFC Bank stayed in one range for 3 years. The price waits for earnings. Guru Finance, a stock which I have and which I recommend. You can just see the stock price went nowhere for 1 year at about 200, and then last year August, when I just seen it, it's been 1 year, it's not moved. Then there was no big rocket science to recommend Guru, but I used to say, nahi yaar, ab Guru lena chahiye. Why? I had no logic. I just said it's not moved for 1 year. Maybe in the next year it will move, but I wasn't sure it is going to go up 80% in the next 6 months. But that's what happened. So if earnings are going up at the same rate, not at a lower rate, and the price of the stock is not going up, or is at an overvalued level, then the price doesn't come down to meet up with earnings. But that happens mostly in companies where you can predict earnings. In companies where you cannot predict earnings, then the price will come faster. They'll say come down faster to meet the earnings. But if you are sure of consistent growth, then the price doesn't come down.
Sir, here the stock specific question, like we were talking about making of tops. So Guru almost went up to 400 and suddenly it didn't stay there for 1 day also.
Right, correct.
And it has fallen down.
Right,
It has
right.
come back to 330, 340.
No, it will not stop at 10% for 2 weeks. 10% off the top. Guru went to I think 375 and it's come to 340 for example. And at 340, it's been there for almost 2-3 weeks. If this story is finished, by this time it should have been below 300. It will not stay here because the selling pressure has to be extraordinarily large at that time for the price to break. And if the selling pressure is large, the stock will not fall just 10% and wait there. The stock has to be decimated to below 300. So that is what one has to think.
Moving ahead, thank you guys for the interesting question. See, I was reading a book on the George Soros, and where he mentioned that he's, I'm sure all of you know about him, heard about it, read about him probably, that when something was not right, something he has taken a trade in the market, his body used to give signals that something is not wrong. He was so into the market, his existence probably depended upon being a player in the market.
He had a backache.
Yeah, he had a backache. So here you mentioned when work becomes passion, wealth follows.
Anything.
So
one way of defining that is, do you feel good on a Friday evening or do you feel good on a Monday morning? If you feel good on a Friday evening and you feel bad on a Monday morning, then work can never become passion. The work will become passion if you feel bad on a Friday evening and if you feel good on a Monday morning. For most stock market guys, we feel good on Monday mornings because the market is going to reopen. But if you're using the market just as a casino, then that feel good is also a feel bad. You have to be an investor for this to work out. But coming to your point on ultimately it's about getting it right, like everybody says. Of course, everybody wants to make money. You're not here for charity, but you've got to get it right. The joy of getting it right is more than the joy of making the money in the later stages, after you've made your money. In the earlier stages, it doesn't matter. You've got to make the money first. So, but once you've made the money, then you say, now I'm enjoying getting it right as well and making the money also. But in the initial stages, there's no substitute for making money.
And you also probably could share a little bit about what you mentioned. The first job of an investor is to look for a group of like-minded people who are focused on serious investing. Having found a group which is selfless and devoted, the first time investor should also develop a habit of reading an act which has no substitute. If you can share some secrets of what really helped you develop this mind frame.
No, I'll tell you, in 2005, 2006, I got a sense that I've become very smart because I was able to make some money. So I said, we'll start a forum, an online forum, and we'll call it the equitydesk.com. And it happened by chance because I thought I'd become smart. I had not become smart at all. Let me tell you, I'll tell you why. So we opened the site and we got a lot of new people coming in, and it was run free of charge, and for 2 years, 3 years, there was a big struggle, and people used to fight for stocks, and we used to, the moment somebody put up a stock, there were 20 people coming and debating on it. It was great fun. It was fantastic learning experience because as a moderator, what I used to do, anybody used to come in with an idea that buy this stock and it's going to grow in the next 2 weeks, we used to delete his comments. We said that we don't want anybody coming here with short-term ideas. So what you got was a set of people who actually made you think like investors, because there were no trading community members around there. And secondly, the questions that were coming there being generated by people, all professionals working in software companies and senior guys. So they made you think very hard. So you were actually exercising with your mind every time when I used to answer those questions. And especially after that, when we opened this Basant's Corner, there we got a section called Ask Basant. There every morning we get questions. So I cannot, it's not like a TV interview where I can come and say, no, if it goes from 200, it can go to 230 and then it can fall back. Because next day morning people are going to come and catch me by my collar and say, what happened, sir? This is what you said yesterday and this is what you are saying today. So the kind of mental framework that happens when you are associated with a group of smart guys around is that you don't share knowledge, you increase knowledge. And that is what I have learned. I don't think I would have been able to write this book had I not opened Equity Desk and not run Basant's Corner. I am sure about that. Because because before 2006 I was happy with my own 3 stocks. I said I had 3 children. Why should I worry about what my neighbor's child is doing? But after that, I was worried about what my neighbor's child is doing, what a child coming from Bangladesh is doing, and what somebody else is doing. Because if somebody told you that this is a stock, what is your opinion on that? You can't say that I just have 3 stocks here, I don't want to talk about that. You have to create an opinion, and you cannot create an opinion without going and referring back. So that was one part of it.
Even now you do a lot of reading and studying regularly, or how
reading, yes, reading happens, but one thing which I don't read is Economic Times at all. We don't get ET at home. So about last week I said now we should get ET back again, because it's been 2.5 years and I said now we should get it. Because I think you can't get rich by reading a newspaper that is sold at 2 rupees here. But becoming rich is never easy. So you can't become, and most of the news you get it in any case on internet and those things. So, but reading is a big part. You cannot, there's no substitute. No, no, of course. No. Thank you for speaking what I had to, but I could not in my mind. Now the point is that there should be no limit. Anything relating to the stock market. One of the best books I have read is, of course, before this one was out in print, is Reminiscences of a Stock Operator by Jesse Livermore. You can say, I'm an investor, I don't want to read this. No, you've got to read it. It tells you the passion of actually buying a stock and seeing it go all the way up. Jesse Livermore is one of the very simple things, but they apply to the market even today. That book was written, I think, about 100 years back. 100 years back. So, but still, it's still relevant today, still relevant. So, it depends, but you can't be reading almost everything and say, no, I'll give you an example. In the online internet community, there's a great fashion for saying, I like Benjamin Graham stocks. Now, what was the biggest Benjamin Graham contribution to the investing community was? You buy a stock at two-third net current assets, I think if I am correct, and then you buy a stock because the company can close down operations and it can return the money back to its shareholders. But sir, if you are buying a jute mill in Kolkata at 2/3 net current assets and you close down the factory tomorrow, do you know what Didi will do? That is out of context. That was in 1930. You were getting stocks at 2/3 net current assets. So things change. You don't get a stock at 2/3 net current. Now you'll say, I'll buy Google only when it comes at 2/3 net current assets. You will never be able to buy it. So every book is relevant, every book is important in the perspective of the environment in which the book has been conceived. One book cannot be relevant for all times because things change, the environment changes. But still people look at stocks and say, okay, can I buy this at 2/3 net current assets? Can I buy this at cash on balance sheet? You can do that, of course. But the point is, if there is a bull market running around 2003 to 2007 and you are looking for a stock at 2/3 net current assets, then you would have missed the entire bull run, 5-year bull run, 2003 to 2008, because you would not have found too many companies at 2/3 net current assets. So you have to change with the times. You say, this is the time, let me see what works best in this scenario. Because the only thing in the investment community that hits an all-time high every second is a bank fixed deposit. You do a 1 lakh rupee fixed deposit, every second you are going to become richer. Every second, every split second, break it into as many parts as you want. But if you are into the stock market, you buy a stock today, it's going to come down tomorrow. And if you say, I will buy this stock only when I am clear. Like in 2008, there were many people who said, I will buy when there is clarity. So when you had clarity, the Sensex was also sitting at 15,000. So you don't get paid, you don't get stocks when there is clarity at the prices at which the stocks were when there wasn't clarity. So everything keeps discounting. So you got to take the pain. You cannot say that I will buy it at only this price from which it doesn't go down. So that is it actually.
But when you know when to cut, can you just share some examples also? For example, we have discussed many stories where stocks have been multi-baggers. But when you say
it's not a big multi-bagger for me, but it's done very well. In 2008 March, I bought Titan, and the stock for 1 year was down 15-20% from the price I bought. And every time it looked that this stock is going to fall 50% because Titan wasn't falling too much. 15% down in 1 year was very good at that time because stocks were being reduced to 15% of their value in 1 year at that time. So the stock wasn't falling too much, and every time it seemed that it's going to fall 50%. So the pain that was there was that, okay, more or less, even if it falls, what can you do? You can do nothing, because if you aren't participating in the market, then it is very difficult to get in when the tide turns. So if Titan fell 15% for 1 year, in the next 4 years it went up 6 times from there, just because I was able to handle the pain. Now the thing is, one thing which has helped me immensely is the ability to remain invested at all times, whether it's good times, bad times, neutral times, whether it's Modi or Mayawati. I am going to be 100% equities man or more than that. It doesn't matter because I have got to be there. If you are running a shop at Chandni Chowk, Delhi, or a shop in Kolkata or Bombay, do you say, no, we got a coalition government, let me close the store. I'll open it only when we have single party government. You don't do it. You don't care about who's running the show. Then as a part-time owner of a business, why should you think so much? If the business is good, it will do in spite of a bad political setup, and if the business is bad, it will fail to do good in spite of the best kind of political setup that you might have.
Sir, what sir, is 100% of your wealth invested in equity, or I mean,
Except the home where I stay and the jewelry at home.
everything is in
Yes.
no FD or no?
No, we take money from bank to invest. Bank and institutions or whatever.
Just trying to understand your concept. When you say that you need to cut your losses, and at the same time you are also saying that you need to handle the pain. So how do you arrive at the
Yeah. You got to cut your losses if the company changes track. You expect a company to grow at 20%, and it suddenly says that there's an enormous problem ahead. We can't grow at 20%. We can only grow at 15%, or at 10%, or maybe shows a loss. Then you got to sell. You cannot keep it. But if the company is doing well and the price has fallen, then you don't sell. That is the difference between what I do and what most traders do, because traders only look at price. If the price is down, you got to sell. You can't keep it. But if the company is doing well, if the earnings are growing, Because in 2008 to 2009, Titan was growing. It's not that they were not growing. So the growth in Titan was the only factor that was helping me remain invested in the stock.
But then there could also be situations when there are one-off quarters or when your macro guidance is factored in.
One-off quarters don't matter too much.
So then by the time you take 2 or 3 quarters, then it's not cutting your losses. You've actually lost out maybe then.
No, but in secular growth companies, the price don't fall too much. But if you're buying a cyclical, then it won't wait for anything. It will fall in 2 weeks almost. But in a secular growth company, see, some sort of, there are several things to consider here. What is the revenue of the company? How much do they expect to grow? And things like that. So it's not a one size fits all, but overall, over a period of time, you get a sense if you own a company, right? This is going to do well for 3-4 years. But you can't, but you will never get a sense of what it's going to do in the next quarter. If you ask me about a company, I can tell you that in 5 years, this is going to do very well. But what is it going to do in the March quarter or in the June quarter? I think that's not possible to predict. Anything can happen in a quarter.
Sir, just one out of context.
Huh.
So it can so happen, just like in 1929, there was a Great Depression. Something like that happens to World War.
It happened in 2008.
Right, it happened, but it did not went on for forever. I mean, for 5 years, 10 years, 15 years, something like that happened.
No, that's enough to kill a person.
That is what I'm saying.
1929 highs weren't reached till 1954, 25 years.
That is what I'm saying. If
Huh.
something like that happens.
Huh.
So will you
See, the index doesn't reach its high, but stocks make highs.
But it can happen, the companies you hold, they'll run into losses, the dividend is stopped.
No, if it runs into losses, you sell in the first quarter. You have to understand whether this is a permanent problem or it's a temporary problem. And there is no formula to do that. It's mostly a sense of several factors at work. But if that happens, you don't wait for anyone. You sell it. Like in the later part of the book, I have devoted 2 chapters to how I sold Titan within 30 minutes of the news coming in. It has to be sold. On one phone, I was hearing the con call of the company, and from the other phone, I was talking to the dealer to start selling. Becho. They used to say कि it's down 3 rupees. Becho or becho. 236. Becho. 234. Becho or becho. The more it fell and the more I sold, the more I wanted to sell. Now, had I sold at 240 and they would have given me a price of say 244, I would have said फिर थोड़ा कम बेचो. They would have said 252, I would have said रुक जाओ. I don't know whether I'm a trader or an investor, but that mindset is there. But if when I say okay, sell X amount at 240 and they say 232 or say 236, then I sell 1.2x, 228, sell 2x. You want to get out of it when there is a problem. See, if there is a stampede around, if you stand in one place, you are going to get killed. If you run over the others, I am not encouraging you to do that, but there is a chance that you might get saved. In a stampede, never stand still. When there is firing all around, what do? You just fall flat. So that is what you have to do.
Sir, again, seemingly contradictory statements when it comes in terms of trying to learn. So you're also trying to say hold on to the times when the markets are crashing, you're a long-term bet.
Yeah.
At the same time, you're saying that when there's a firing all around. So for example, I'm a new...
No, firing all around means if your company isn't delivering on results. If you've got a company that is not performing as per your expectation, then you should sell. But if the entire market is collapsing, but your company is doing well, then there is no need to sell.
Asian Paints was doing all good, even during 2008.
Ah,
Asian Paint 2007,
absolutely.
सब चल रहा.
Right, right. So had you been a holder in Asian Paints, Page Industries didn't fall in 2007 to 2009. It didn't go up even, but from 2007 to 2009, Page was at one price.
So what had you seen exactly at Titan when you were selling in a hurry?
Pardon?
What had you exactly seen at?
No, I had not seen anything. Titan was taking gold on lease, and the RBI had come out with a directive that this gold on lease funda will not work, and that meant that Titan had to put up cash upfront to buy gold. They could not take gold on lease. So when you put cash, your ROC goes for a toss because you need more capex to work. Then you can't open 100 stores. You can open only 3 stores or 5 stores or 7 stores because all existing stores will need to be funded every time. So that was a big problem, and that was, I still remember the management said getting to the old ROEs is a far, far cry. I still remember this word, far, far cry. When I heard far, far cry in the first 2.5 minutes, I should start selling. Oh, bol diya far, far cry. There's no need to discuss too much. But when the news came, the price of the stock was 250. When the con call started, the price of the stock was 242 or thereabouts. I didn't sell at 250. I was clear I have to sell. But when I heard far, far cry and the price was 242, 243, whatever, I said this is time to sell. There's no need to research. Of course, stock fell and today also it's at the same price, but the idea is that if there's a problem, then you got to run. You can't fight it. Sometimes it's better not to fight a problem, but to get away from that. We are not promoters of a company. Why should we be there for 20 years? We are investors. I get a better option, I'll say, like, company it is doing well today even. Why should I hold on to that? Of course, you don't do that in a family. Once you're married, you stay there. But in a stock, you get a better option, you move away.
Sometimes we in family have to probably. I think this principle probably has been also covered by Peter Lynch in his book Beating the Street. Buy what you see.
Right.
Can you share? I think probably touched upon it with the Pantaloon example. Anything else interesting? Like, for example, can you give us some examples as tomorrow if you go out, how can we spot opportunities, more forward-looking ideas? Like tomorrow, I think this is a dynamic world, and there are definitely many more new companies will come out. There will be new opportunities, new ideas. So can you just give us some kind of framework on architecture? Where can we, how to spot opportunities? Something on those lines.
No, the first thing there is that a company with a satisfied set of customers will not have an unsatisfied set of shareholders. If the customers are satisfied, they are happy, then more often than not the shareholders will be happy. So when you move around, let's say what can happen tomorrow. In India, almost everything has been covered. Whatever had to come to India has come into India. But I'll just give you a small extempo, a 2-minute extempo. It's there in the book. You wake up in the morning, what do you see? You see Colgate. You could have bought Colgate in 1980 the first time you saw it. Stock is up 100 times. You go to have a bath, you see Hindustan Unilever shampoo. Lever you could have bought in 80s. You are on a dining table, Nestle. You see Britannia, stock up 250 times in the last 20 years. You're calling somebody on phone, 2003. There, in 2003, I remember people debating, why don't you take a Reliance connection? It is cheaper to call. Why are you having an Airtel connection? Why don't you buy the Airtel stock? Because instead of worrying so much about which plan is cheaper, you could have actually gone and bought the stock. So if you're going to office, you're coming back, you are looking at Hero Honda, you're looking at things like that. So these things cannot be predicted that in 2018 India will have this particular. So suppose tomorrow somebody manufactures a drug which is not the drug which is sold in Punjab, but the other drug, which says that you take one capsule a day and after 1 year your height increases by 2 inches. And the stock of that company is already up 3 times. Already up 3 times the first time somebody tells you this. So that is the buy what you see concept. But the big part about the buy what you see concept is such stocks don't move for 2-3 times, they move for 20, 30, 40, 50 times. All the buy what you see companies, the ones which I have listed here, Horlicks, Colgate, Hindustan Unilever, Britannia, Nestle, Page Industries, they've all gone up 50, 60, 70, 100, 200, in fact Asian Paints has gone up 2000 times in the last 30 years. So these are the stocks which you want to see, and once you have seen them, they will be expensive, but you have to take a 20-year call there. Like when I bought Page, there were a lot of problems. The first problem in my mind was, it's a franchisee company, it doesn't have the license with itself. Why should I buy it? But I was using Jockey for so many years. We never realized this. So, and the promoter was selling. They are selling even today. So the second part was, the promoter ही बेच रहा है, अब आप कैसे लोगे share? But then the buy what you see concept was so strong within me that you bought it, like Pantaloon example which I shared. So things like that.
How much research do you do on the management of a company?
Say good management in a bad business. Good management in a bad business, Tata Steel, you don't make money. Okay? Bad management in a good business, United Spirits till the time Mr. Malia was there, you don't make money. Good management in a good business, most of these MNC, Ferra companies, till the time they don't do any hanky-panky, you make a lot of money. Bad management in a bad business, Kingfisher Airlines, you blow it up in 2 years, 3 years, 4 years. So management is important, but what is important is what is the management being given to manage? Ratan Tata is there handling Tata Steel, Tata Motors and TCS. So, it is not a question where you can say I will only buy companies with a good management. You can do that, and you can say if the good management is given a bad business, then what can the management do? Nothing, almost nothing. At least a good management in a bad business will protect capital. It will not let the capital blow off. A bad management in a bad business will take no time to blow it off. So, that is a combination of factors. It is not a one size fits all, but the best thing to do is a good management in a good business.
Sometimes there could be a discrepancy between what is good
Pardon?
Sometimes there could be a difference between what is good for a customer and good for a shareholder. For example, Kingfisher Airlines, good for the customer, bad for the
No, why was Kingfisher good? Tickets were always expensive. I always used to fly Indigo. No, if you're looking at, if you are interested in the air hostess, then Kingfisher is good. But the point is, normally people used to have a fancy for Jet and Kingfisher in the early years, in the first 2, 3, 4 years. Then people realized it's not worth paying so much. Then people shifted to Indigo and things like that. So this is not a situation, but you knew who's running it. You had a sense how good the management is. You get that. It's not difficult to expect it.
On the other hand, if you look at a company like a HDFC Bank, which is very stringent when it advances loans. So if I'm a customer who's looking for a loan, probably HDFC Bank is not my first choice. I'm more suited towards approaching a state-run bank. And even as a customer on the side of a customer who's looking for basic services, probably
Which bank do you have your account in?
HDFC Bank.
Why?
I'm an I-rated customer.
No, but have you shifted?
Haven't, because it's a very sticky business. Again, you mentioned that.
Yes, yes,
Then,
that is it.
if you're looking at buy what you see concept, and I hear a lot of people who are again irritated about the quality of service dropping down with regards to HDFC Bank, would you still hold on to the stock as an investor, because you're looking at business differently from that of a customer?
See, if you're just having a savings account there or a current account and issuing checks and depositing checks, then you will shift tomorrow. But if you're having an entire set of facilities from a bank in terms of cash credit, LCs and bank guarantees, which businesses do, and you are writing them insurance policies and things like this, then it will be very difficult for you to shift. And a bank needs people from whom they can make money. Basically, if I only have a current account or a savings account where I give 10,000 rupees every year, the bank will be too happy to tell me, okay, thank you sir, please move on. We feel that by closing this account, the bank is losing, but basically the bank is gaining. Because the bank wants to hold you back in some other way. They want to sell you policies and things like that. So, of course, there is a lot of talk. People are really upset with the way HDFC Bank functions in several branches. But overall, the point is that is this a crowd or it's a small fraction of people? If it's a crowd, it will show up in the results. They won't be opening so many branches. If it's a small fraction of people, then the results move on. Sometimes, like I'll say, I don't smoke, so ITC is a useless thing. Cigarette smoking is bad, but ITC is not useless. ITC has made a lot of money. My thoughts have to be a part of the general thought. I can't have a different thought and expect everybody else to be thinking that way. Reflected in the results.
I think this book is a wealth of knowledge which I definitely cannot cover in this time allotted. But one final thing which at least I personally also tend to commit this crime, and probably many of you also, maybe we get to speak back. The time an investor spends in discussing unpredictable macro trends like inflation, GDP, unemployment, etc., is inversely proportional to the time he would have for doing other useful things. So, do you understand the importance of like GDP, inflation? How, like, do they really play a role in your investment?
No, see, if you are holding 10 companies, 15 companies, then you are more interested in what those 15 companies will do rather than interested in what the 120 crore population of a country like India are doing. So, you are interested in what your 15 companies are doing, and when you are holding 10, 15, 20 companies, then over a period of time you will get a sense that these companies, like I will give you an example. There are companies which are very closely linked to the entire economy, and in those kind of companies it is very difficult to make a lot of money, because the economy will not be good for 20 years at a stretch. It will be good for 2 years, it will be bad for 1, it will be good for 2 years and then bad for 1, and the cycle keeps on repeating itself. So, the companies also will also be influenced by what the overall economy is doing. But if in a scenario where the overall economy is doing very good, then your company will also be doing good, but if the overall economy falters, then so will your company. But if you have held on to such companies, it's very difficult to make money over time. On the other hand, if you have a set of companies that are doing well irrespective of the overall macro environment, then it's possible to make money. What happens in those companies is, if the environment is bad, they grow at 25%. If the environment is good, they grow at 35-40%. That's the difference. But if you have a company which is growing at 35% in a backdrop of a bad environment, then when the environment is good, then that company can grow at a higher rate. So the difference between good and bad comes here, and why I don't look at macros most of the time is not because I don't like looking at macros, but because I think that that's not a fair value addition to the set of companies that I hold. So that way. But if you are buying most cyclical stocks, then that's also a factor to keep in track of most of the time.
So what is the top 5 numbers you typically look at when you invest in a company?
It's given here. First is sector tailwind. Sector tailwind means there has to be something happening to that sector, in the sense that overall people have to, overall those set of companies should be doing well, and not just one of them, all of them. Like for example, if you buy a company, if only ACC does well and India Cement doesn't do well and Shri Cement doesn't do well, then that's not a good enough reason to buy ACC. But the entire set, because big multi-baggers, big winning bets come from companies that are part of a sector that are doing well, not individually. Secondly, you look at growth, then you look at so many things, other management perspective, other things. But given an option of buying a company in a bad sector, or buying a company with a bad tailwind or with a headwind, and a company with a good tailwind, where even if the manager of the company isn't too smart enough, he still is able to grow, then it's better to buy a company which has got a very strong tailwind, because then he can grow without putting in too much of an effort also.
And what about cyclical? If you think
Cyclicals, you have to buy it, you have to buy cyclicals when there is total gloom around, and there's no one way of defining that. How can you define when there's total gloom around? But when you have to look at it the other way. Cyclicals, you have to buy them when they're reporting losses, but the losses should not be such where the company isn't able to recover its interest costs also. So that is one way of looking at it. But if cyclicals are doing too well, then it's time to sell. So you don't buy a Tata Steel when steel prices are doing well and Tata Steel is doing phenomenally good on its number front, but you buy them when they're doing bad, which is quite the reverse of what you would do when you buy a secular growth company. So there's a big dichotomy here, but the one big plus in a cyclical is you can buy any of them and you'll make money. For example, you can buy Tata Steel, you can buy Hindalco, or you can buy Finolex Cable, or you can buy anything, you'll make money. But in sector specific companies, if you miss one page industries, then you won't get another one very fast. So that's a problem. So in a cyclical, it doesn't matter which one you buy. You can buy Havells or you can buy V-Guard. Over a period of 10 years, if Havells does well, so will V-Guard. There's not too much to choose about, because the entire sector moves. Of course, one will do better than the other, that's another issue, but it's not a case where you're going to lose too much.
So I remember talking to you last event that you were very positive about Hawkins speaker. So you were telling me that there are a lot of social schemes going on, Narega is there, direct cash deposit.
Right.
So rural economy will be booming. So there is some kind of macroeconomic factor which you were considering when you are buying Hawkins.
Obviously, that's what I said, right?
Yeah, similarly for Pantaloons retail, there was ITS, ITS sector was there, middle class was coming up. So I think you look at some macroeconomic factors.
Obviously, you have to look at the sector tailwind I said. Like what has happened? 2007, the government came and they said, okay, let's do Narega. 2008, farm loan waiver. Sixth pay commission. And then what happened? Suddenly you found prices of land are increasing all over across in rural India. Price of gold went up. So rural India owns a large part of gold. So they got the feel good effect. They got the wealth effect. Then there's education and literacy happening in rural India. So I was at the IAIP, I think we were at the event last year or this year earlier, and one guy from I think IIM Ranchi or IIM Kolkata, I don't remember, he said, I am from a small town in Andhra Pradesh where you won't believe it's a small village. So that guy, if he goes and works somewhere and he gets a salary of X amount, he'll be writing a check to his parents every month. So then suddenly there's a transfer of wealth. So when the price of food, vegetables and those things go up, then what happens? There's a transfer of wealth from urban India to rural India. You can say, okay, take a middleman will take some money, but that's okay. But the point is that there's a forced development. Now what happens after elections? There's a big spending happening in rural India. You won't get money for vote, but those guys get money for vote. Many get caught, but most don't. But that's also a thing. You have to understand that once the tailwind happens, then you look at companies that will do well. Of course, some companies won't do well every time. For 1 year, 2 years, they won't do well. But more or less, they will do well. That is that is not a month on month, week on week inflation number analysis or a GDP analysis. That is a trend. You see, in the next 10 years, what's going to happen? In the next 10 years, we will have one more Nasik, one more Pune, one more Gurgaon, and one more Sikandrabad, and one more that way. So there is an entire urbanization happening. Like I'll give you an example. A stock which I have recommended, but I don't hold. Even Narendra Modi said, "Pehle Devalay, fir Shauchalay." Look at Sera, 1200 crores market cap. Country like India, 120 crore population, 50% don't have a bathroom. Finished, story over. No need for further analysis. Now the point is, you'll say, do you think everybody is going to buy Sera just because they see Kareena Kapoor sticking on that wall? No. The point is, first you will have a matti ka toilet, then you will upgrade. The process will be on. Like if India has to grow a stock, you need to construct. If urbanization is to happen, then malls, shopping complexes, housing. Why not Kajaria? Tiles. Story over, finished, game over. So if you get a company at 1200 crores market cap and a population of 120 crores India, Sera, it's expensive, it's gone up, it just hit a circuit last week, but you just have to think of it on those lines. And bathroom sanitization is a big issue happening. Like river interlinking project, which happened in Gujarat, it's happening in northern Madhya Pradesh right now. If it happens all over India, just think how much money there will be made in the agriculture sector. So these things matter, but they are not that, in the first week of February, 10% of rivers were interlinked, but in the second week of February, only 6% rivers were interlinked. That's not a question. In inflation numbers, GDP numbers, it's all bogus because it's all a statistical data. एक साल high आएगा तो next year low हो जाएगा, एक साल low हो जाएगा तो next year high आएगा, because you're just comparing with the base, and the base goes up, then the other one goes smaller, and the base goes higher than the other one, that way.
I think this is good. So this is some vignettes from this book, and I'm sure all of you will read and will probably enjoy it. Thank you, sir. Thank you so much. Now moving to the second part, I think all of us we don't have much time, but in a couple of minutes, probably you can share some insights on how did you see the market shaping after election. Once again, this is a big event which is happening.
Right.
What are your thoughts on that?
The first thing is, I don't generally have a short-term view. I don't have a short-term view generally, but I am a very big proponent of buying anything on new highs, even though I am an investor and I don't look at charts and things like that. I don't do those technical analysis, 200-day moving averages, I don't do that. But if something is at a new high, it tells you. So in February, we wrote a small note to the members of our Basant Squad, a couple of them are here. The title of that was "Seems We Have Broken Out." I think Nifty was at 6400 or thereabouts that time. 6400, seems we have broken out. That was the only heading. And we said it's broken out because at 6400 the Nifty wasn't coming down. Now please don't crucify me for giving you a price based talk, but that is how you have to start thinking. So from there on, the Nifty has gone up. It's at 6800. Now it gives you a sense that we are set on path to a new market, a new bull market. Now will the old stocks do well? I don't think so. It has never done well. The old stocks can only bounce, but they will never hit lifetime highs. So what do you have to look? You have to look at new stocks all the time, in the sense that a new sector is being born, and what will that sector be? That will be a different thing. But if then you look at the policies of the new government that comes into power, how it comes into power. But the first stocks to participate in the run will be the beaten down sectors, the ones which have a lot of debt on balance sheet and things like that. and that will do well. But over a period of time, once you have the entire market into bull zone, then I think the big theme to look out for will be semi-urban and rural India. Anything connected to semi-urban and rural India should do well, because this part of India is growing well. I gave you talk to any banker, he will tell you the growth that he sees in Sangli is not the growth that he sees in Mumbai. Small towns in India, they are doing very well, phenomenally well. And when those people buy products, and then how do you play it? You play it with the under penetration thought, that what are the stocks that are under penetrated in rural India, sectors rather, or products. So then that is how you go about it. So in a short run, what will happen if Narendra Modi is voted to power? I think 70% of stocks would already have gone up by the time he takes his oath. Market moves ahead. They will not wait for clarity before putting those stocks up. What happens after that? We go back to the theme of rural and semi-urban India and things that are doing well at that time. Because if India is to grow at 9%, 8%, 7%, then that growth has to go over into rural India. You look at HDFC Bank's balance sheet, you look at Kotak Bank, what they say, meet those guys around. They'll say the growth that we get in semi-urban and rural is very different from the growth that happens in urban India. So I think on a broad scale, you can bet on elections, you can buy stocks that are into power transmission, into cables, and into the heavy debt companies. But on an overall basis, the stocks that will do well are the ones where you have a 4, 5, 7, 10-year view, and that will be more focused on the semi-urban and rural theme. I think we put a chapter there also called chapter 14 where we discuss about that. But I think that's a story which is going to happen for the next 4, 5, 7, 10 years, because you don't want to make money 30%, 40% just because a prime minister you thought looked good for you to watch over TV has come to power. You want to buy stocks for the next 5, 7, 10 years, and that's what you have to do. Because I don't think any one of you are here who think that if only I had 40% more money, I would have considered myself rich. But there will be many people here who would say, if I had 20 times more money, I would have been rich. So the idea to become rich is to hit that big six rather than drop and play the ball for a single actually.
Also, I just want to understand, how do you see Indian economic growth panning out over the next say 10, 20 years as against other emerging markets, and within India, what are the sectors you're looking at? Say, of course, you mentioned underpenetrated sectors in rural markets, but some specific sector names maybe you're looking at over the next 5 to 10 years.
See, personally, I think rural low ticket mortgage is going to be huge. Two companies, Guru Finance and Repco, I have elaborated that here. Maharashtra, Gujarat and Tamil Nadu constitute more than 50% of India's mortgage market. And if you bought Guru Finance, which is an HDFC subsidiary, which is in Maharashtra and Gujarat, and you bought Repco Home Finance in Tamil Nadu, you have almost covered more than 50% of India's mortgage market. And look at the inherent strength of these companies in the sense that they are into businesses where banks don't come in, because they actually lend to people who have that earning power but don't have documentary evidence to show that they have earning power. In the sense that suppose there is a guy who sells vegetables on the road in a small town, he doesn't put his money into bank, so he cannot have documentary evidence to show that he can borrow money from a bank. But what happens is, when these guys go there, Repco and Guru Finance, these fellows, they know the entire area and they map him around and then they lend to him. What happens in real estate deals? You buy a house for 10 lakhs and you don't write a check for 10 lakhs, you write a check for a little less than that. Of course, I don't know whether I'm allowed to say this, but that's what happens. So the value of the house is always more than the value it has been stated for. Secondly, there's a down payment element, and with every installment, the bank's liability, the bank's loan keeps coming down and the value of the asset appreciates. So it is a challenge to lose money by lending somebody against his house, unless you lend it to him in Nepean Sea Road or Barakhamba Road in Delhi and things like that, because their prices are high. But if you go into semi-urban rural, then that's one great place to be in. And look at the market cap, 2,000 crores, 6,000 crores, 7,000 crores. So a huge market ahead, maybe 20-year story. You don't know. So I'm a very biased investor. If I know I've got a stock that can grow for X number of years, so I don't normally like to look somewhere else, because I'm assured of this growth, and then what happens is, as you get convinced about a company, you put more money to work also over a period of time. So if you want to pin me down to one theme that's going to do well for the next 10 years, rural mortgages, low ticket rural housing. So there are ways to, now it's not sure that for 10 years these companies will do well, they can also falter, but then there are ways to find it. If you found that in the 5th year they are not doing as well, then you sell them and move ahead in life. Had you met me 1 year back, I would have said, "Arey title le lo yaar, 10 year story hai." And in 10 minutes the entire thing changed, because the perception changed, and market is about perception. Earnings come later, first there has to be perception.
So there are a lot of NBFCs which are focused on the rural area. Do you think,
But what are you financing? Are you financing a tractor which is worth 4 lakhs and is worth only 3 lakhs the moment it rolls out of a showroom? Or are you financing a home which is worth 4 lakhs and after 1 year can be worth 4.5 lakhs also?
but so they are in a host of, divisions.
See, it depends. First home, small home, 10 lakhs, 15 lakhs, that's not affected by economy too much. That's not affected too much. People keep making money out of them. But if it's a thing which is related to the market, like second hand commercial vehicle financing, for example, then unless you have the economy working, truck kahan chalaoge, kiska maal kahan le jaoge? But, and people say you have two problems at home. You have got a house on mortgage and the bank is claiming that, and you got 5 trucks on mortgage. Which one would you leave first? I don't think you're going to leave the house and go and stay in the truck. You're going to leave the truck and stay in the house and say, "ठीक है, ले जाने ले जा, हम टायर खोल के रख लेंगे पीछे से," whatever. But the last thing a person would like to leave is his house. So I think it's a story. And you've got a US example, Fannie Mae, Freddie Mac, $57 billion, I think 2007, 57 billion. And US mein, it was not a free ride. Here you have a free ride. There's no bank there. See, in the below 5 lakhs, you have Mahindra Finance, you have those companies coming in. Banks above 15 lakhs. So in the 10 to 15, in the 5 to 15 lakhs, is a clear winner. Now, these things happen, and it's also semi-urban rural theme.
So even low-cost housing which are focused on B-grade, C-grade cities, they will probably do well.
They'll do well, but you can buy a dealer, you can buy a real estate stock also there. But there the problem is, you don't know too much about it. You're not assured for 20 years. I don't think you can be as excited about DLF for 20 years as you can be with an SDFC. So it's a question of how assured you are about the growth. Because again, markets are about perception. If you are not getting that perception that this company will grow for 20 years, then you can't hold the stock. You have to get that perception first.
And so with a population of 120 crore people, do you think consumer stocks will, continue the run?
It depends on what consumer stocks. See, 120 crore people, if you say 80-90 crore people are already having a bath with X amount of milliliters of shampoo and X grams of soap every day, then they won't have a bath 2 times or 3 times a day just because they've made more money. But those kind of things you have to see as to what, that's why I said that you have to look at things that are under penetrated. You don't have to look at things that are already on the saturated levels. For example, you can also say ki, like a cigarette business, it's thoroughly saturated, but look at the replacement cycle. How much? 1 minute, 2 minutes, 10 minutes, 20 minutes, depending on the kind of smoker you are. Okay? So if the saturation level is very high, then the replacement cycle has to be very low. You can't have a product where the saturation level is very high and the replacement cycle is also very high. Then there's a problem. So that is how you have to balance it out through. So in soaps they do well, but a soap, they say ki is very difficult. It's like a person, you can say, when you buy a soap, a person buys a soap like he's flirting with someone. You buy 2-3 brands suddenly. अरे नहीं इस बार ये ले आओ, कैमे ले आओ, इस बार लक्स ले आओ, इस बार ये ले आओ, देख लेते हैं, उसमें सस्ता ऑफर निकला, whatever. But on a face cream, you will never do that. No, yaar, I only use Nivea, I only use Garnier, whatever. You don't test that. Toothpaste, you don't test as much. You don't go from Colgate to Close Up and then Close Up to Baba Ramdev's toothpaste and back to Colgate again. You don't do that too much. You're focused on one. So it's a question of how sticky you are. Like one thing which people are sticky are underwears. So jockey.
What about the economy in general? Like how convinced are you about the India growth story?
See, my perspective is totally different. I don't want to say that I don't care whether India grows or not, because as an Indian I have to care. But from a stock market perspective, if I bought 10-15 stocks, then another way of refining that sentence is to say, in spite of whatever happens, we should grow. So if India grows, these companies will grow 10% faster. If India doesn't grow, these companies will grow 10% slower. But if you buy companies that are thoroughly linked to the India growth story, then India can't grow at 8% GDP for 30 years. And if India can't grow at 8% GDP for 30 years, then it's very difficult for you to, as an investor, to grow your portfolio by 25-30% for 30 years. So the magic is actually trying to ascertain the amount of companies or the character of the company that will grow irrespective of how fast or how slow India grows. So I think that is one thing to look about. But on an overall scale, I think India can grow. There are too many macro analysts doing that here. I mean, if I do it, I know I'm going to get it wrong. So there's no point, because nobody knows. I don't think even our FM or the governor of RBI would know. So it's futile. But whatever. But we are sure that our company should do well. That's the point.
I think there will be very engrossing discussion. I think there will be many more questions which we can probably Basant can take during snacks. Once again, we are truly indebted to him for his candid discussion and sharing the secrets of his success and helping us all become better investors and attain financial freedom through stock markets. Once again, a big round of applause, sir, for his insights. It's a pleasure to have you, sir, and look forward to your continued guidance, sir, going forward.
Thank you.
Thank you so much.
I think one of the key things would be that the US gave the world the intelligent investor, and it's time India paid back with a thoughtful investor. Before we break, can I call upon Mr. Saurabh Agarwal to present a memento on behalf of IAIP to sir?
Thank you so much.
We have some tea and snacks lined up, so would request all of you to proceed towards that. With that, we come to the end of the event. Hope you enjoyed it. Thank you so much. Yeah, one more thing, you must have received some evaluation forms. Please fill them up and put them on the table in front of you. Thank you so much.
आप बताएंगे नहीं, हम फॉर्मेट